Hey, what's up, guys? John here. China is dumping U.S. treasuries at an alarming rate. And the reason for this, I believe, is because I think that they are anticipating a massive credit event in America in which we are going to start to see a wave of banks continue to fall. Not just Silicon Valley Bank, Signature Bank, First Republic, PacWest getting acquired by Bank of California, these small little situations. I'm talking about a wave of dominoes that are about to fall in the U.S. banking system, and I believe that they are anticipating the government's going to step in and print a ton of money to try to prop up our economy, and they want to get out before the insanity starts. I'm going to back this up with facts. I'm going to show you what's actually happening that the media is not talking about. The media is kind of painting a picture like everything's completely fine, but the facts, they say otherwise. I'll break it down for you. Hit the like button. When you hit the like button, YouTube will share this content to educate the people about what's really going on. And if you want to fix your credit, you want to position yourself for the greatest wealth transfer of all time, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you remember in 2008, when things hit the fan and there was other consolidation, what happened? The only people with exceptional credit were able to go out there and invest. They were to buy out these incredibly low-priced real estate transactions. They were able to go out there and buy these foreclosures. They needed great credit to do it. If you have bad credit or even average credit, which is a 698 in America, if you need help, we'd love to give you a free consultation at my company, GreatCreditFast.com. GreatCreditFast.com. Late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions. You have negative items impacting your credit score, get a hold of us. One late payment can drop your credit score upwards of 180 points and will stay there for a whopping 7 years. A whopping 7 years. That's absolutely crazy. You have one, let's say in 2022, it'll stay there until 2029, preventing you from being able to invest. Go to GreatCreditFast.com. Take a look at this. China is hiding $3 trillion in foreign currency in shadow reserves, adding unknown risk to the global economy. Now, here's why I believe that they're anticipating a credit event. So, two recent academic papers put total unrealized losses, U.S. banking balance sheet, between 1.7 and 2 trillion at the end of 2022, and things have only gotten worse since then. As interest rates continue to rise, balance sheets at banks become deteriorated. Only slightly less than the total equity capital of 2.2 trillion in the entire banking system. So losses on the balance sheet between 1.7 and 2 trillion, and they say that total equity is about 2.2 trillion. Like that is an absolute bloodbath waiting to happen. You look at China's ownership of U.S. Treasury down a whopping 481 billion from peak levels. The rate of selling is accelerating. For many years, the experts always doubted that China would dump debt because of the impact of their own economy and currency. You can see how the line is steepening. China's getting out of debt and buying gold, right? And you look at, the facts are China's central bank adds more gold for the ninth straight month. Ninth straight month, they're acquiring more and more and more gold. So you look at the facts are saying that they're anticipating something pretty big, right? So you go down here and it says, half of China's currency reserves were hidden, a situation that add risk to the global economy down the road, former Treasury Department official said. While the country's state administration of foreign exchange reported 3.12 trillion in foreign assets last December, SESTR estimates the foreign exchange reserves actually sit around 6 trillion, right? So they're hiding half of what they actually have. China's so big that how it manages its economy and currency matters enormously to the world, he wrote in the China Project. Yet over time, the way it manages its currency and its foreign exchange reserves has become much less transparent, creating new kinds of risks for the global economy. A key indicator from China's reserves is a sudden pause in its reported activity from 2002 to 2012. China's foreign exchange reserves steadily rose as central banks bought U.S. dollar assets to prevent China's yuan from appreciating too much, allowing exports to remain cheap. But over the last 10 years, China's reserves stopped rising, which is puzzling as China's trade surplus has continued growing and currency stands at an all-time high. SESTR, who previously was the Deputy Assistant Treasury Secretary for International Economic Analysis, is now Senior Fellow for International Economics at Council of Foreign Relations, has an idea of what's going on, right? So just as China has shadow banks, the financial institutions that act like banks take on the kind of risk that banks might normally take but aren't regulated. China might be called the shadow reserves. Not everything that China does in the market now shows up in the People's Bank of China's balance sheet, right? Well, look at this. So global impact expansion to inject new vitality, right, into BRICS. Some people might say, oh, this is a BRICS situation. I think this is a banking situation. I think this is the dollar crisis situation. Because if you look at, despite regional banking crisis being over, deposits from the U.S. are still facing the fastest pace on record, the falling at the fastest pace record. Look at this. This is falling off of a cliff. Even if you look at great financial crisis, 2008, 2009 deposits, right? You look at, late 90s, early 2000s, like this crisis here, This is nothing. Like, this is nothing compared to what we're in right now. Meanwhile, money market funds just hit a whopping 5.6 trillion. They added $1 trillion since 2022. Despite money market funds and CDs paying substantially higher fees, banks, they're paying close to 0%. So you have inflation, they say it's 3-4%. Some people would say it's 15 to 20%. Why would you put your money somewhere for 0% and basically lose 1 or 1.5% every single month? You wouldn't, right? So people are saying, I'm just going to put it in CDs. As interest rates rise, this trend is becoming more prominent. Why keep your money in a bank for 0.01% interest when you can make 5%, right? Agreed. But to add to the injury that banks are feeling right now, they are now forcing regional banks face another hit as regulators force them to raise debt. They're forcing these banks to raise debt as they have less cash on hand than ever before, and they have more delinquencies on their auto loans, on their consumer loans, their business loans, on commercial real estate. They're suffering more and more and more, and then they're coming in and saying, you know what? Here's some new regulations. Add on some more debt to that, right? It looks to me questionable. Regional banks ready for a wave of bond issuance. Credit Weekly, lenders forecast to issue $40.5 billion to meet new proposals. And they say that half of Americans, they're supportive of the U.S. government guaranteeing individual deposits, right? And that banks fail. So Americans, they want the government to step in and bail everybody out. But at the same time, the government's pushing all of these new actions that are going to force these banks into insolvency, right? So it doesn't make much sense. Look at this. U.S. faces more interest rate rises to cool inflation. Jerome Powell's going to continue to increase interest rates. He's going to keep rates much higher for much longer. If you asked any real estate investor, in 2022, when are they going to stop hiking rates? I promise you probably 8 out of 10 of them would say, January. They're going to stop in January. Well, we're 10 months past and we're stepping into another likely interest rate event coming this month, right? Coming this month. And they say more interest rate rises, not, they're going to rise one more time. This is going to be a few more hikes at a minimum, right? So this is going to just put more and more and more weight on these banks. But Janet Yellen told bank CEOs more mergers may be necessary. Now I'm going to connect the dots on what they're saying about these bank mergers because it's fascinating here. The more you look at this, the more you'll see what I see. So June 25th, Yellen predicts more bank mergers, right? May, so this is twice. She said this twice. Yellen told CEOs more mergers may be necessary, right? Then June 28th, June 25th, maybe this is the same situation. But look, June 7th, Yellen says more consolidation, right? So she keeps saying the same exact thing about consolidation. Then you have this, Economist. Why Americans will soon see a wave of bank mergers. And then if you look at who actually owns this, then you scroll down here and you start to see, some very, very, very big names that everyone has heard of. And so when you look at this family and you look at, the amount of power that they have, you would probably bet that they maybe see things before other people, right? Before the general public. Maybe they see things before everyone else is aware of them. And so what I think is very likely going to happen here is I think we're going to start to see a wave of 2 or 3 problems. The first is student loans are going to be due in October 1st. You have roughly 17% of the entire U.S. population is going to start to pay on these student loans. Average balance, $503 per month. $503. You're talking 48 million Americans are going to have to start paying these debts in 3.5 weeks. 3.5 weeks, right? So we're going to have this situation. Then, on top of that, Jerome Powell's increasing interest rates, so the cost to service existing debt, credit cards, home equity lines of credit, is going to be more and more and more expensive. Insurance is continuing to rise. You're seeing everything that's happening around the world right now. All these insurance crises are going to continue to rise for auto insurance, home insurance, right? So the pressure is on for U.S. consumers. And as this is all happening, you have $1 trillion in commercial loans that need to get refinanced in the next 12 months, $2.7 trillion that has to get refinanced from now until 2027. And when you see these high interest rates, what does that do to asset valuations? It pulls it down dramatically. As assets are going down, taxes and insurance are going up, rents are softening. It's a bloodbath waiting to happen across commercial real estate. So you start to look at all these things. Consumers are getting hit from every single direction. Inflation is going to going to continue to get much, much worse as energy prices continue to rise through all these new energy policies. So you're walking into a massive event that's unfolding, and you're seeing China, you're seeing other locations, other places around the world preparing for this event. And I think it's very wise for smart and savvy investors to pay attention to what's actually going on and position themselves in the best possible way, which is to get out of high interest rate consumer debt as soon as possible, have the highest credit score possible. Like ideally 770, 780, 800. Like you want to have exceptional credit. You want to ask yourself the big question. If you were a bank, would you want to lend you money? Without knowing you, without having any relationship with you, just looking at you on paper, would you want to lend you money? If the answer is no, you want to change that as soon as possible. You want to change that as soon as possible. Because what I think is going to happen, banks are going to have to lend, but they're going to be extremely cautious on who they lend to. Because when banks, that's how they make money. When they can't lend, they're going to go quickly out of business. I do believe there's going to be people that are going to get loans, are going to be able to go out there and buy distressed deals, but it's not going to be everyone. It's going to be a small percentage of the population. Just like 2008, 2009, when things hit the fan, the only people out there investing were people with exceptional credit that offered very, very low risk. Most people got cut out of the market entirely, and they had to watch some of the most incredible opportunities, investing opportunities go by. What do you think of this entire situation? Do you think we're walking into a big, big problem in the banking crisis, in the banking sector? Drop it below, hit the like button, add me on IG. And if you want to fix your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative items, go to GreatCreditFast.com. Schedule a free strategy session below in the description, and catch you guys in the next video.